As I've articulated over the course of the past year, I believe there's a compelling need for this rule, in addition to our legal obligation for it. Throughout the past year, credit union officials have often asked me, since credit unions did not cause the financial crisis, why do we need a new rule on risk-based capital? And the short answer is that it's required by law. The Federal Credit Union Act requires NCUA to update risk-based capital standards to be, quote, comparable with the federal banking agencies. FDIC, OCC, and the Federal Reserve issued new risk-based capital rules in 2013, so in fact, we've already fallen a year behind, or more than a year behind now. In addition, both the Government Accountability Office and our own Inspector General found that the existing NCUA rule on risk-based net worth failed to prevent credit union losses as a result of the financial crisis. GAO concluded that NCUA should propose, quote, additional triggers for PCA that would require early and forceful regulatory action, unquote. The Inspector General noted NCUA needs a PCA framework that will identify increasing risks on a timely basis well before losses occur. However, even if we were not compelled to do so by law, by the GAO, or by the Inspector General, requiring complex credit unions to hold sufficient capital to offset their risk is simply good public policy. Simply put, addressing the problem of capital inadequacy of high-risk outliers protects the entire credit union system. Let's not forget, while credit unions did not cause the financial crisis, they were deeply affected by it. During the crisis, NCUA had to extend $26 billion in liquidity to prevent the credit union system from collapsing. Without an infusion of $20 billion from NCUA's central liquidity facility and an additional $6 billion from our line of credit at the U.S. Treasury, the credit union system, as we know it, would probably not have survived. As we know, natural person credit union losses resulting from the crisis reached $750 million, losses which had to be paid by all surviving credit unions. Many people assume that natural person credit unions failed during the crisis because they held less than 7% capital. That might seem like a logical conclusion, but it's not correct. To learn more about the institutions that failed, and so as not to skew the results based only on crisis failures, I recently asked the staff to review the failures of natural person credit unions from before the crisis, through the crisis, to after the crisis, and what they found was really eye-opening to me. In the last 10 years, 192 credit unions failed. Yet 24 months before they failed, their average net worth ratio was over 12%. Officials in those credit unions likely believed they had more than enough capital to offset their risks. But clearly, holding net worth more than 500 basis points above the statutory 7% still wasn't enough. Today, credit unions hold average net worth of 10.9%. So for those who believe today's credit union system has too much capital because the average net worth ratio is 390 basis points over the statutory 7%, they're potentially in for a rude awakening. Don't get me wrong, I'm not saying each credit union needs to have net worth ratio over 12%. I am saying each credit union needs to have enough capital to offset its own risks. A well-designed risk-based capital rule would do exactly that. It should also be flexible and forward-looking. So credit unions can choose to concentrate in high-risk assets. That's fine. But their risk-based capital requirements should match those risks in order to prevent losses. And had the risk-based capital rule been in place before the crisis, it would have reduced losses to the share insurance fund, which surviving credit unions all had to pay. As we consider this proposed rule, it's important to note that this rule would require only 27 complex credit unions with high-risk portfolios to bolster their capital base. In the future, as more credit unions attain complex status, this rule will prevent even more costly failures and save surviving credit unions from paying for their losses. As I mentioned, the agency has adopted many of the changes proposed in the comment letters. One issue we did not change, as Steve indicated, was supplemental capital. and we are specifically inviting comments on changes we could make in the future. As many stakeholders know, I have long supported legislation to authorize healthy credit unions to raise supplemental capital for the purposes of strengthening net worth. However, such authority raises complicated issues that would need to be addressed through changes to other NCUA rules, such as consumer protections and amending share insurance fund payout priorities. So to gain insight and the benefit of stakeholder experience, the preamble poses 6 questions about supplemental capital for commenters to consider and anything else they want to provide. I encourage commenters to offer suggestions about how NCUA could address those issues in subsequent rules. Excuse me. Another issue that was raised during the comment period for the previous proposed rule was NCUA's legal authority to promulgate this rule. Several commenters claimed that unlike the banking agencies, NCUA only has authority to design a single risk-based requirement to be adequately capitalized without a higher tier to be well capitalized. This issue is so fundamental to the risk-based capital framework. I concluded that the agency should not move forward with a rule until we received an independent legal opinion from an outside counsel analyzing our authority. So this past summer, while I was on vacation, I solicited 11 law firms around the country that specialize in financial services statutes and regulations. I solicited the independent legal opinion in order to perform my own due diligence. I felt that we had to be absolutely certain that we had the legal authority before we moved forward. I ultimately chose the global banking and payment systems practice of Paul Hastings, based in Washington, D.C. Paul Hastings' partners have years of experience on legal issues related to PCA from the perspectives of financial institutions as well as from the perspective of a federal agency. In preparing the scope of work, I made it clear that I wanted their unbiased legal opinion on the issue, and that NCUA would not influence or predetermine the legal opinion in any way. If the opinion found that NCUA did not have legal authority to propose different risk-based thresholds to be well capitalized and adequately capitalized, then we would have redrafted the proposed rule accordingly. The firm researched every legal issue in the proposed rule for several months, during which outside counsel reviewed all 2,056 comment letters, plus any additional letters we received that questioned our legal authority. In November, a team from Paul Hastings presented an oral legal opinion to the NCUA board. The oral legal opinion maintained that while certain parts of the Federal Credit Union Act are arguably ambiguous, it did support our proceeding with a two-tier risk-based capital framework comparable to the banking agencies, with one threshold to be adequately capitalized and a second to be well capitalized. During the oral briefing and in the weeks that followed, my board colleagues and I had opportunities to ask the outside counsel any questions we had about our legal authority. While some lawyers may present conflicting opinions about our legal authority, the fact that there are different statutory interpretations clearly demonstrates that reasonable minds may differ on this issue. Even if the law is determined that it is ambiguous, deference is given to the agency unless the regulation is, quote, arbitrary, capricious, or manifestly contrary to the statute, end quote. In our case, the proposed thresholds of 8% to be adequately capitalized and 10% to be well capitalized are certainly not arbitrary, capricious, or manifestly contrary to the statute. In fact, we've clearly established that these thresholds are comparable to the banking agencies as required by the statute. So I'm very confident that we are moving forward on solid legal ground with this proposed rule. The cost of the Paul Hastings legal work included $100,000 for the oral opinion and the multiple consultations with board members, plus $50,000 for a written opinion. I should note that this is not a new budget request. It was paid in 2014 from our Office of General Counsel's line item for contracted legal services. My intent actually was to release the written opinion at this meeting. This week, however, the board received a letter from the law firm refusing to reverse their policy on confidentiality of written legal opinions. We have asked the firm to reconsider, and we hope to be in a position to release the written opinion in the near future.